Let's get the view of BlackRock. They see some opportunities despite the rocky start to the year. They write the following: while caution is warranted, we believe the equity risk premium continues to make a case for equities. Stock valuations have come down. Company earnings remain solid. Tony Despirito joins us right now. Tony, I was looking forward to this. You talked about the optimal portfolio to combat a recession versus one to combat inflation. How different are they?
Well, the truth is they're very different. To combat inflation, you want a very cyclical-oriented portfolio, stocks like energy stocks, bank stocks, etc. To combat recession, you want more stable compounders, healthcare staples, utilities, the like. And so, given the amount of uncertainty out there, what we've been saying is, look, really balance out those risks, create a barbell portfolio. You know I'm a big fan of a barbell portfolio, but let's tilt that barbell portfolio a bit more towards the recession resilient side, particularly emphasizing healthcare, which in the portfolios I run is our single largest sector weight by far.
Tony, why do you think that particular sector on that side of the barbell is still underappreciated?
Yeah, well, first of all, when I look at the long term, I think healthcare has a great outlook. Healthcare grows faster than GDP because we're aging as a society. And that really distinguishes it from other recession resilient sectors like utilities and staples, which if you look over long periods of time, actually fall as a percent of GDP. Healthcare is very recession resilient. It's proved so in the past. I think it'll be again in the future. In fact, it might be more recession resilient in the future because more of the payments are coming from government, whether it's larger Medicaid rolls. Our older population means more people on Medicare, and then the exchanges and the subsidies that go with those exchanges. And then finally, when I look at valuations, the valuations of healthcare stocks are still below market multiples, whereas staples and utilities have been bid up above market multiples. And so all those reasons lead me to more investments in healthcare than either of those other two sectors.
The piece of the other side of the barbell that I wanted to discuss were financials. Energy will resonate with a lot of people as the optimal inflation fighter because it is the source of inflation right now and has performed really well up until recently on the S&P. The financials haven't delivered, Tony. The profits might have in certain pockets, but the stocks haven't. Tony, what do you make of that?
Well, I view that positively because that means the valuations are even better at the moment. We're seeing a slew of bank earnings right now, and very consistent themes. Net interest income, really strong. We're seeing rising net interest margins, higher than people might have expected, and that's simply because banks are awash in deposits, so they don't need to raise rates that much on deposits, and rates on assets are going up much more quickly. Plus, we're finally seeing loan growth for the first time post the pandemic. So net interest income very strong. For the money center banks, we're seeing great numbers out of their trading books, and that's because the market's been so volatile. And so that's a nice kind of cushion, if you will, counter-cyclical cushion that they have. And so I like the fact that earnings are strong. Obviously, as discussed in the previous segment, we've got to watch credit expenses. But one of the things I like, particularly in this quarter, if you look at net charge-offs versus what they're accruing for loan loss reserves, they're building loan loss reserves, meaning they're taking more expenses on the income statement than is warranted by what they're charging off. That means they're preparing to cushion on the downside should the economy slip further.
That raises the big question, Tony. That raises the big question. The relationship between rates and underlying profit, net interest income, all of the above, that's well understood. The relationship between rates and stock performance at this stage of the cycle, Tony, that's the important piece of this. What is the relationship between interest rates climbing and stock performance at this stage of the cycle when a lot of people are looking for a recession potentially in the second half of this year?
So right now, as you point out, there's a lot of fear about the economy because of rising rates. I think that's the opportunity on this side of the barbell, is that these stocks are just too discounted for what the fundamental outlook is.
Do we need the recession risk to fade, though, for that to start to deliver?
Yeah, I think that is once we see the credit losses actually come through and see that they're not that bad, I think that's when the stocks will probably deliver in all honesty. And when you look at the last couple of recessions, obviously the pandemic, credit was extremely pristine actually through the pandemic. The global financial crisis, credit was horrible. I don't think it'll be either. I think it'll be somewhere in between, much more akin to what we saw in the early 2000s. And when you look at valuations, that means these are long-term good bets.